Good afternoon and a very warm welcome to you for our special discussion today on multi-asset funds presented in association with Aditya Birla Sun Life AMC Limited. To set the context, as investors, most of us have experienced spells of volatility in the Indian equity markets in recent times owing to a range of factors such as geopolitical events, inflation, fluctuating crude oil prices, and of course, central banks across the world, including the RBI, initiating a slew of measures to bring down inflation. Well, on that note, since inflation levels have finally started to taper down, investors are trying to beat the cycle and equities seem to be lucrative once again. But as the volatility in stock markets remain, investors are in a dilemma whether to invest into stable fixed income products or equities which can help beat inflation, or perhaps go for a mix of both. So how much to allocate in which category? That also makes for a pertinent question. Now, great option here is multi-asset funds, which offer investors a tactical asset allocation solution across a broad mix of asset classes, including equities, debt, and commodities, and that gives you the benefit of a diversified portfolio. Every few years, it is seen that a different asset class emerges as the top performer. Now, that could be equities, debt, gold, or real estate, while at the same time another one slumps. But not every investor has the expertise to create a tailor-made portfolio or hire the services of an expert to do so. It's here that multi-asset funds offer a ready-made portfolio which brings the gains from different asset classes. Now, multi-asset funds, they typically invest at least 10% of their portfolio into a minimum of 3 different asset classes and are there for risk-averse investors who are looking for stable and consistent returns on their investments. Now, choosing a portfolio that combines asset classes, that safeguards you against this and offers steady long-term returns for investors in all market conditions, particularly in volatile markets. So, ladies and gentlemen, if you'd like to know more, then join me, Gautam Srinivasan, in a conversation with Dhaval Shah, who's the Fund Manager and Senior Analyst with Aditya Birla Sun Life AMC Limited. Dhaval, of course, will tell us more about multi-asset funds, the key benefits that they offer, and what kind of investors they are best suited for. Dhaval, great to have you with us and looking forward to getting a better view from you on multi-asset funds.
Pleasure is all mine, Gautam. Pleasure to be
Thank
here.
you, Dhaval. All right, let's start with the basics and let's expand on what are multi-asset funds. I gave a primer earlier. If you can expand on that definition and also add in how are they different from, say, balanced advantage funds, which also offer investors a portfolio which is sort of a mix of debt and equity.
Yeah, so multi-asset funds typically invest across 4 asset classes. One is equity, which is the predominant asset class. Second is debt. Third one is commodities, which is largely gold and silver at the moment, which is restricted to. And last but not the least is real estate, which you can invest through REITs or InvIT structures which are there. And you did ask, how does it compare with balanced advantage funds? Most of the balanced advantage funds are largely restricted to asset classes, which is equity and debt. So here you're getting, the benefit of 2 additional asset classes, which actually helps. And that's the major difference between multi-asset and balanced advantage funds that we're trying to look at. The second major difference which is there is that, a multi-asset fund typically has a predominant equity, which is around 65% kind of an allocation towards equity, which, might deviate in a range of 10 to 15% plus or minus. So the larger range for equity comes to 50 to 80%, right? Similarly, for debt or for fixed income, it is 10 to 25% kind of a number. Versus that, if you look at a balanced fund, which typically runs on a model which is tracking, various parameters, be it valuation parameters or momentum parameters or volatility parameters, they offered a much broader allocation on equity, in terms of ranging from as low as, 25 to 35 to as high as 80 to 90, depending on how these various parameters are panning out. So that's the 2 large differences which are there. More number of asset classes with multi-asset fund, but a predominant equity portion when it comes to, multi-asset fund versus others where, there is a higher flexibility in a dynamic asset allocation model.
Absolutely. And I want to narrow the focus now in terms of the benefits, but from that perspective of volatility, because one of the USPs of multi-asset funds is that they're all-weather assets. So can you enlist some advantages of investing in multi-asset funds, especially in today's times of volatility?
Sure. So if you will look at the history, and let's look at the history which you will see in the slide from 2005 till date, right? And you will classically see that different asset classes are performing differently across various phases of the market. And you will see that wherever there's a green patch, which is the patch where overall GDP is doing well, or we are on an improving GDP mode, invariably equity and asset class does very well. And fixed income and gold relatively does not perform as well. But say from 2005 to 2008, as you could see, is where the phase is. But post that, when the correction happens, when the economy is slowing down for various reasons, you invariably find gold and fixed income doing very well versus equities, which have very sharply corrected that over a time frame, and so on and so forth, as you will see. So the essence is that as long as you have asset classes which are not having a very high correlation, if it has negative correlations, then on an overall basis you have a fairly steady portfolio with a multi-asset fund, which should give you better risk adjusted return versus you're trying to fine tune every asset class in the overall journey. So that is where is the big USP of a multi-asset fund, that you get the benefit of all these asset classes put into one fund, which can give you that optimal solution that you're looking at from an investment perspective.
Absolutely. And I want you to expand on that, because in a sense, you're getting the best out of every asset class, and taking that thought forward, the multi-asset allocation approach, that is enabling investors to expose their portfolio to the risks and at the same time rewards associated with different asset classes. And that helps them derive steady returns through different market cycles. So if you can elaborate on that thought for a lot of the viewing audience out there.
Sure. So, what typically happens is that if you were to look at the, correlation of equities to, say, fixed income asset class, they are positively correlated, but that correlation is very low. It is like a 0.1 kind of a correlation that you're trying to look at. That means that, when equities are doing well, typically you will find, interest rates also are increasing in that time frame. And at that point in time, debt does reasonably okay, but not handsomely well as much as equity does. In fact, gold does better than fixed income in those kind of time frames, is what history has suggested. But on an overall basis, while we are seeing that when we look at the correlations reversing, and in the sense that when actually GDP growth rate falls, you will invariably find that at those points in time, while equity corrects because of earnings cut and because of multiples cut that we're trying to look at, interest rates also fall, and that falling interest rate cycle, you invariably find fixed income doing well. And people run towards safety, and at that point of time, gold as an asset class is also something that people jump into, and that is where gold also does relatively well. So that is the whole essence of what we are trying to look at here, that fixed income and gold, if you were to allocate in a proportion which is closer to 25 to 35% of the overall portfolio, along with 65% of the equity, then you tend to have, over a very long period of time, on a risk adjusted basis, a much appropriate equity like return with much lower volatility that you're trying to look at. And that is what the endeavor is for a multi-asset portfolio to actually offer to the investors.
You mentioned time frame, so I want to look at it from the time frame perspective for investors as well, because a lot of them have different goals which have different time frames. So does your investment horizon also have a bearing on this investment decision? Is there an optimum time for which one must remain invested if we are, say, looking to park our funds into multi-asset funds? And is there an entry and an exit fee there?
The ideal time frame for the multi-asset fund to show the overall characteristics is when you complete the entire bull and the bear market, and that typically takes somewhere at around 6 to 7 year period based on historical track records that we're trying to look at. So an ideal time frame, ideally for an investor to benefit out of a multi-asset fund, should not be anywhere less than 5 years. It is always a 5-year plus kind of a perspective that we suggest to invest in a multi-asset fund that we're trying to look at. On a second question, there is no entry load, when you're trying to look at such investments, but there is an exit load to the extent of 1%, mostly, when your investment is less than 1 year. So that's the characteristics of the entry and exit load for a multi-asset fund.
All right. And in any discussion when it comes to an investment instrument, how can taxation be left behind? So, a question to you on that, Dhaval, because like balanced advantage funds, which need to have a minimum allocation of 65% in equities from a tax perspective, do multi asset funds have a sort of a similar benchmark? How are they taxed?
Yes. So here also, we have equity taxation because of the fact that we have minimum 65% of the allocations into equities at all points in time. Even if you were to take a, conservative view on the market and, overall allocation to the equities reduces, it is through hedging of the equities so that the cash equities at all points of time is 65%, so that, there is an equity taxation benefit that you get in the whole product that you're trying to look at. So all asset allocation for equity going below 65 is done through hedging mechanism, which enables the benefit of taxation on an overall perspective, which balance advantage funds also have it, and multi-asset funds will also have similar advantage on the taxation front when you're trying to look at it from that perspective.
All right. And before we let you go, a few more questions. What is automatic rebalancing portfolio and how does it help investors looking to put their money in multi-asset funds?
Sure. So if you look at, automatic rebalancing portfolio, typically what happens is an investor's journey starts with a predetermined asset allocation that you're trying to look at. But say after a year or two, when, particular asset class has done well and the others have not, that overall percentage of allocation differs. And then to rebalance that is an extra effort that the investor has to do at the end of the predetermined time frame, and typically it is 1 year that every investor will go through that. Here with a multi-asset fund, that gets automatically done on an overall basis, largely because of the fact that we maintained a predetermined allocation. And as and when various asset classes move, depending on our overall market outlook, we try to rebalance that and come back to that overall allocation, which is prudent. And there is history to the whole thing, that if you were to look at it from a perspective that there is a paper written in 1991 by Gary Bernstein and Brain Singer, which says that 90% of your returns are actually determined by asset allocation. And that is where if you were to do, back testing of data for the last 20 years, you will invariably find an allocation of 65% equity, 20% debt, and 15% gold does provide you, in the Indian context of 15% kind of a CAGR versus, pure equity providing you 17% kind of a CAGR, gold providing you 11% kind of a CAGR, and debt providing you 7% kind of a CAGR. So, and from a volatility perspective, again, you're trying to say that the average drawdowns are 40% lower when it comes to a multi-asset fund versus what you experience in equity or gold. So on an overall risk-adjusted measurement basis, I think this, overall reallocation which you're trying to do, 65% equity, 20% debt, and 15% gold, has proven historically to be very good in an overall risk-adjusted framework basis that you're trying to look at from a return-making perspective, and that is what the multi-asset fund is typically offering you when you're trying to look at this hypothesis.
So it's the sensibility of that investment product which is its biggest attraction point, because as you said, there's data backing that balance, which helps you achieve the kind of returns. And also when we look at a broader economic environment of uncertainty, is sensibility the biggest USP of this product?
Absolutely. So it's actually a good product for an investor who doesn't want to aggressively rebalance their portfolios themselves and who's not looking in day out of the markets, when to enter and when to exit, but wants a asset allocation which will take care of them over a long period of time. And that is where this whole sensibility of that investment actually makes a far more important framework that you're trying to bring in for the investors, which will help on an 5-year plus kind of an investment framework.
All right. And how popular is it as an investment product in India? Just because a lot of the time for investors, that's also something they would want to know, that as in, is it an emerging, is it a niche category, or is it rising or soaring in terms of popularity? How popular are multi-asset funds in India?
In fact, that's a very interesting question. It's actually an emerging category in the sense that, more and more people are now wanting to look at multi-asset. In fact, many of the people have earlier looked at, hybrid funds with only equity and debt. And that's a fairly popular category. But to add, gold or silver, as well as, real estate via REIT and InvIT is something which is emerging as an overall category, and which is where we think that this product will offer a far more stability, because typically real estate InvITs have very high yield, which you will compare it to various other debt products on an accrual basis. Then you're better off on a longer term to invest in a real estate InvIT on that overall basis. And gold has typically offered a far better hedge on that overall sense that you're trying to look at. So it's an emerging category, and I think it has a long runway to go over the next 10 years as a part of that overall investment that you're trying to look from an investor perspective.
All right. And one last question. Any do's and don'ts that you would suggest to a lot of the investors, potential investors who are watching, who maybe are looking at the idea of multi-asset funds more closely after this discussion?
The first don't is that, don't try to benchmark this to a pure equity fund, because this is, not having a complete equity allocation at a 65% allocation on an average that you're trying to look at. You need to be invested over the entire cycle that you're trying to look at to see the real benefit that you're trying to look at from that overall fund. So, that's the essence of what we're trying to look at from a multi-asset allocation perspective. In the do's, I would say that, for any investor, this also becomes a very good vehicle to do systematic investment. That is an SIP model, where an investor who has a recurring income month after month, then I would strongly urge them to look at this fund as a regular investment and do an SIP month after month for whatever amount that he or she is comfortable with, to build up a portfolio over a 5, 7, 10-year perspective that you're trying to look at, because this will provide you fairly stable returns across various asset classes that you're trying to look at from that 5, 7, 10-year perspective.
All right. On that note, it's time to wrap up our discussion today. Thank you so much, Dhaval, for joining with us, and of course sharing with us the more insights that are driving this space, multi-asset funds. And I hope there's a lot of information for investors to process and digest and make a decision. Thank you so much for providing them with those points. And I'd also like to thank Aditya, Birla Sun Life AMC Limited, for partnering with us for today's session. Till next time, this is your host Gautam Srinivasan signing off. Have a great day.